Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, October 16th, 2019. Pretty much a flat day. We're a slightly down day, but nothing much. So not a lot to report new in the markets. I'll keep this recap relatively quick, and I'll share some thoughts on where we might be headed from here, and a couple things to take into consideration in the coming weeks here. Start out with what happened with QQQ today, and again, not a whole lot. We're down a quarter point. So what I'm focused on, there's a lot of lines here on this chart. Let me give you a cleaner board here. What I'm focused on are these lines here. Number one is this price channel. And I'm not putting a huge emphasis on this, by the way. It's just there's not a lot that pops right now in the 60-minute charts to me. But we do have this potential price channel. There were quite a few reactions there. And in that channel, like most price channels, I can draw a midpoint line. You can also use a tool called an Andrews pitchfork that'll do something similar for you and give a midpoint line. But I usually just prefer to draw my midpoint line because sometimes it's not exactly in the middle, but quite often it is. Either way. And as I mentioned, usually you're either trading below that level on the bottom half of the channel, and once you break resistance, which is the midpoint, then it acts as support, and you tend to trade on the top of the channel. And again, same story. So that's been the MO lately. Wouldn't be surprised. In fact, I'm leaning towards we pop down probably tomorrow and start trading on the bottom of the channel. Now we could break, obviously give us a sell signal, but we need another reaction off this trend line because we had quite a few here, but we haven't visited it in a while. So if you're an active trader, and I shared this with members today, and you shorted Qs, there's a couple quick pullback trading ops. Again, we ran into that downtrend line off the highs from late July there the other day. That was yesterday's highs. So far that stopped the advance. We also had on the 60-minute time frames on both the futures and the index ETFs here small 60-minute divergences, and so you're talking just a quick short-term pullback trade. Could be more, but you're talking about 1.6%. And target there, if we do get a pullback tomorrow, whether it comes on a gap down or not, would be the top of the gap. This is the gap from the other day right there. And it comes in almost perfectly with the bottom of the channel. So it looks something like that. And that would allow you to either cover on a quick trade or move your stops down if you want to let it run, see if there's going to be any more downside. Now, I shared this with members of the site today in the video I did earlier today, and some notes that I posted on that when that video was posted. Is my best guesstimate is we'll probably kind of grind around over the next couple weeks here in the market. The reason being is we're now getting into the thicker earnings season. This week, the big earnings, it was most of the bigger banks had reported, so it was a financial week for the financials. But market, they didn't move the needle on the market, nor do they usually. They don't have the same weighting that technology does. So what I'm looking out for, and again from my experience and doing this year after year, is the market often tends to go into a holding pattern before the big five report. The big five to me are what I call the FANGs, and that's not F-A-N-G, it's F-A-A-M-G, and that's the 5 largest companies in the NASDAQ 100. That's Facebook, Amazon, Apple, Microsoft, and Alphabet, which is the G-O-G or G-O-O-G-L, depending on which share class. And in addition, you have Intel, which is the 6th, depending I haven't looked lately, it's either the 6th or 7th largest holding in the NASDAQ 100. And I'll just read this off to you real quick. Okay, Microsoft kicks it off on October 23rd, reporting earnings after the market closes, followed by Amazon and Intel on October 24th, the following day, followed up by Apple and Alphabet on October 28th, and concluding with Facebook on October 30th. So those are your biggest market moving. Those include the world's largest companies right there. That includes the only trillion-dollar companies in the world right there. So we're gonna watch those, and I'll say this: be prepared for anything. There could be some market moving headlines that come out and jar the markets up or down before then, but barring that, my expectation probably grind around. And remember, last week we had some near-term bullish events. We took out those downtrend lines, those smaller downtrend lines. We took out the top of the August trading ranges in both SPY and QQQ, and we did it impulsively. So that was clearly near-term bullish right there. That was the gap up, and we've been moving up since. That was the catalyst, those breakouts. But you know, how much farther do we go? I can tell you, although I don't have strong convictions on where the market goes over the next couple of weeks, I do have pretty strong conviction on where it goes. You know, the next, let's say, 10, 20, 30%. I think the upside is limited. I've been saying that for a long time now, and that's where we haven't gone up any higher. Where I said the upside, I still believe at best is limited from where we're at now, probably about a few percentage points, 2, 3, 4, maybe 5%. That's what the charts seem to indicate. If it's anything more than that and starts to develop, we'll try to adjust my analysis as quick as possible. So I think the risk reward, for chasing new longs, I've shared a lot of long trade ideas on the site, quite a few, actually dozens. I probably 50, yesterday alone, 30 something today, several more trade ideas, all longs, but not a single one of them has anything or hardly anything, if anything at all, to do with the broad market. We're talking things like commodities, natural gas, Bitcoin, cannabis stocks, the euro, the US dollar. So things that are either completely different asset classes, or if they're equities, they tend to have zero correlation and almost an inverse correlation to the broad market because they're not components of the S&P 500. And that's where, again, I think where the opportunities are right now. More bang for your buck, if you will. So the markets continue their slow grind. Watch that channel and watch that downtrend line. And, of course, like I said, usually you get this close to new highs, you're probably going to pop them, but maybe not. And if you do, it's, to me, again, it's just not worth it. There's no clear objective reasoning for going long here, nor do we have any sell signals right now on the near-term charts or anywhere to go short. So we'll watch these. Let's see how the markets develop, and if I see anything interesting, I'll update it. NQ, talking the futures real quick. Remember, like QQQ, SPY, the ETFs, we also put in on the 60-minute charts negative divergence here, right here, from this point to this point on the futures. And so far that divergence has been playing out, this little megaphone type action. PPO is bullish right now, meaning it's above the zero line. This is a zero line, and although trading, remember, this using the PPO as a trend indicator works pretty darn well during trending markets, but not during, this has been anything but a trending market. It's been a trendless, big, choppy, sideways market for months now. We had a near-term downtrend, now we're in a near-term uptrend, and so, if you want to look at it that way, you can see the PPO starting to curl up here, and so we could have a little more upside. I don't know, maybe a little more downside if these 60-minute divergences play out. Normally, when I see 60-minute divergences, that's when I position long for the next, trend down or trend up if it's bullish divergence. But like I said, right now with earnings coming out, especially a lot of the big names, and what's going on the daily charts and the weekly charts, I'd rather just, fry. I think there's better fish to fry elsewhere right now. So I've cut back on my active trading, day trading, and still sitting tight. I have quite a bit of swing shorts that are still about where I entered months ago, and I'll hold on to those. And then my active trading account, like I said, focus on some other things right now. That was NQ. So we'll see if those divergences play out. If not, I just showed you a little minor uptrend line. I'm leaning on a little more downside. Usually you do get it with a 60-minute divergence like that. But if not, watch for a pop above this little small megaphone pattern. And if we do head down in the futures overnight, again, pick up where those trend lines are. Watch those trend lines on QQQ, and SPY has a similar trend line. ES, the S&P 500 E-mini futures. Here's a minor uptrend line to watch right here. Most important, I know there's a lot on this chart, but what stands out is right here. This is your negative divergence, your divergence line. wash, rinse, repeat stuff. Divergent high, correction, divergent high, bigger correction. This was really an extension just of the same divergence there. So that's when it played out for the bigger drop. Small divergent high right here, small correction, and we do have a 60-minute divergent high. So it's worth noting. If it breaks there, that would bring us down. So like I said, near term, normally I might say, this is a decent swing trading op, and it may prove to be. So if you do short it, just like anything, just set your stops and don't let it get away from you, because you can see the PPO is in bullish territory right now. It could cross down soon, but if it curls back up, then what could happen is maybe these divergences stay intact, they just extend. And so maybe we get another leg up. Maybe the market wants to make a run or a poke at those, tests of those previous highs. Maybe not. Like I said, charts, because of earnings and everything else, I would keep things light. That's my preference right now in the broad markets. And on that, like I said, the banks reported this week. You got somewhat of a lift, but you can see if you look at the bigger picture and the financials, have gone nowhere. Look at this board here. This is XLF. Covered this recently. I don't know if I did it in the end of day videos. I usually sector analysis is typically remained for our reserve for the subscribers on the site, but this one you can just see it's nothing big. It just shows you multi-year, 2 years, financials have been locked around in this range here, barring that we had that meltdown in the fourth quarter last year with a V-bottom snapback rally, and we snapped right back into that range. And so all these big earnings from the financials couldn't do anything, couldn't even get us back to the top of this channel yet. So it's like a lot of other sectors, almost everything out there other than the defensive issues, the REITs and the utilities, which have a very minimal, hardly any impact on the S&P 500. Those are near highs. Most other sectors, energy is in a big bear market. Most other sectors are well off their highs. So as I've been saying for a long time, it's all about tech. This is it right here. XLK, breakdown right here. 1, 2, 3, 4 weeks now below the trend line off the December 26 lows, and my guess, unless something big happens before then, probably another week or two, maybe a back testing until these those big market leading tech stocks that I just covered earlier report. Finally, I'll say there's Bitcoin. Like I said, I'm focused on alternative assets that have very little, if any, correlation to the broad market. This was Bitcoin. I don't know if I think it was. Yeah, I shared it as a public post about 7 weeks ago. I posted the Bitcoin was poised for a 25% drop. Even before that, I posted. I made the case that Bitcoin, the rally in 2019, was just the first major first bear market rally within a new bear market. The Bitcoin was a bubble. The bubble popped, and back in July, this was dated July 18th, I had us going up from there, rallying off from that point in late July, coming up from there, and then coming down to drop about this 882 target that I've had for a long time. Followed up in July. That's when the post calling for a 25% drop because we broke this support. That's what I was waiting. We broke that 1222 support, had us coming down here to 882, and that was 7 weeks ago, August 30th, and boom, today hit. So these are the things right now where your trading is just a lot more conducive. And there's just more, potential for both longs and shorts. I actually reversed this one today. I have some price targets, but that's it's an official trade, so I'm not going to go over those now. Those are based on the 60-minute time frame. But there it is. And again, not much else to cover on the broad market when you have a flat day like this. So every now and then we'll focus on, touch on something else. And finally, again, I try not to fall asleep at the wheel. Volatility might be low right now, which makes it not conducive for active trading and swing trading, active swing trading, that is, or swing trading as a whole. When you have a stock market that has now gone hardly anywhere in, that's last, what is that, September, September 21st, and here we are today, where we're trading today, up 1.5% since September 21st. So that makes, investing is pretty much, market's been plateaued here, and that's because a lot of the other sectors, other than the tech sector, are down and have been moving lower since that point in time. So that's why I think it's going to be an important week. Keep an eye on those big FANG stocks, and it's all about this one, QQQ and XLK. So we'll follow up, and if anything big happens before then, or if I notice any developments, I will post an update. Otherwise, if we have another flat day tomorrow and nothing big happens, I may skip the end of the day update and just focus on, like I said, the other commodities and individual stocks and sectors that I'm focused on and trading right now. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.